Welcome back. This is part 2 of this chapter, and we left off on historical geometric versus arithmetic average returns. We'll talk about how it's calculated in a moment, but the idea is that when you go long term, notice this here from 1926 to 2020, when you go long term, you will notice that when you use the average return, the geometric average return, it's gonna give you a lower number. So it becomes a little more conservative on the long term, while this version, this is just your standard average. You just average it out like you normally do. We'll talk about the formula. This one's a little different. But this version, it's gonna be more optimistic, give you a little higher numbers. And it's just the nature of the calculation. So long term, this one gives a little lower, more conservative approach. So which one should you pay attention to? We'll talk about that in a moment. This is the formula for a geometric average return. What you do is you grab every return. Let's say it's yearly. This could be monthly. This could be weekly. It could be daily. It doesn't matter. Let's just say yearly for the example. So you take returns of year 1, returns of year 2. And what you're doing is you're putting a +1 in front of it in each one of them. And then what you're going to do is you're going to multiply them for so many years you do. Once you have multiplied them all together, you grab that number and you're going to put an exponent there of 1 over t. Let's say it was 20 years. You would have 20 of these. Multiply with these 1 plus each one of them for 20 times to every year for 20 years. Multiply all 20 together. And then that number, you would put an exponent there of 1 over 20 if it's 20 years. And whatever number you get out of that, you do a -1, and that's how you get the geometric return. So arithmetic return versus geometric mean which one is better? Well, it depends. As you saw earlier, long term, one is more optimistic than the other. So this is a rule of thumb. It's not perfect, but it's kind of like a guide. If you're doing 15 to 20 years or less, in other words, less than 20 years, you want to go with arithmetic average. If you do much longer terms, 20 to 40, you can go ahead and calculate both and then just, go in between them. If you're doing 40 plus years, which is very long term, then you want to use geometric. And let's go back to this slide. It makes sense because if you're doing 40 years, that's very, very long. These numbers are going to be very high and could be misleading. So this will probably give you a more, I don't want to use the word realistic, but a better number to follow. And of course, if you're doing a shorter period of time, these might be too low to what's really going on, and it might throw off your decisions on your investment decisions. Efficient capital markets. So let's shift gears to the efficient market hypothesis. A couple of things. Stock prices are in equilibrium. This could be a more complex thing to define, but for now, look at it as every stock, it's given the appropriate return for the risk associated with that stock. So the relationship, the relative return between stocks, it's appropriate. It's a good return given the risk of each one of them. So there's not one stock doing something abnormal. Stocks are fairly priced. Same kind of notion that the price of the stock reflects its intrinsic value. Informational efficiency, meaning that everybody, well, let me not say everybody has access to the same information, but the information available is efficient across the market. If true, you should not be able to earn abnormal or excessive returns. Now, they're not saying that you cannot make money. What we're saying is that you shouldn't have a unique advantage of making more money than the person next to you or anybody else around the world. Is if you both do the same calculations, you're both accurate in your estimations, then you should both get the same returns because you have the same information. If you both have the same calculations and the same information, you will end up with the same result. And then you both end up with the same returns. So efficient markets do not imply that investors cannot earn a positive return. Yes, you can make money. What we're saying is you're not going to make more money than the next person that has the same information that you have, and assuming things are in equilibrium and fairly priced. So that's like the baseline of this. However, things that disrupt this temporarily, these disruptions are not permanent. They just cause some swings. One thing out of many is what we know as overreaction and underreaction or delayed reaction. There's a lot of difference. So overreaction here, the way to define it, would apply also to underreaction in the sense that either people went over the price that it should be, and that's the dotted line here. So something happened, right? So this is reality. The solid red line will be like reality, the intrinsic values. So everything was fine. Something happened, stock price goes up, and that's where it should be until the next thing happens. But what happens in real life is that when the event happens, people don't automatically go straight to the price it should be. What happens is some people calculate it or estimate it's going to go up even a little higher. So they react to it, and that's what happens here. But then once reality kicks in, it normalizes and it goes down to where it should be. A delayed reaction could be that, yes, people had the right number when the event happened, but they didn't take action on it. They didn't act on it until later, and it caused, or some did little by little, and it took some time for it to reach where it should have been here. An underreaction is the same as overreaction, but it just kind of swings under, where people, when let's say the event actually dropped the stock price, then people kind of swing a little more under where it should be, and then it goes back up to where it should be. Forms of market efficiency. So this is a hypothesis that was developed by Eugene Fama, a Nobel Prize winner. And he had 3 levels, I guess we can say: strong, semi-strong, and weak. Strong form efficient market. This is where everything, all information, public or private, everybody knows everything. There is no insider information. There's nothing secret. Everything is known by everybody at the same time. So that's what they say, that if you had inside information, you couldn't take advantage of it and make abnormal returns because everybody would have that private information that we're talking about here. So that'll be strong form efficient. So yeah, if everybody has the same information, then it's very efficient because nobody is better informed or has an advantage over nobody else. So it's a very even, fair playing ground. So it'll be strong. Semi-strong. Okay, information is only what's publicly available. So the big difference is this one says private information, which everybody knows and it's not private, but I think you get the message, is that it's included for everybody. Here, only publicly available information is what's available to everybody. So there's some people out there in this level that have private information. We can also call it privileged information. We're not going to get too deep into that in this lecture, but privileged information and private information are very similar, but there's some legal nuances on the difference because I can make the difference between insider trading or not. However, what's important to know is public information. The private piece is not here. So some people have more information than others. So what we're saying here is that fundamental analysis in this case, meaning that the information that is available publicly, like financial statements, historical trends, etc. Everybody will have access to that. So when they participate in the market, they all should get about the same returns. Nobody should get abnormal returns. However, just to put a side note, if somebody with private information takes action on it, then they would have an advantage here. Weak form efficient market. The only information available is past prices and volume data. This is straight up, strictly technical analysis. You're using past trends to predict the future. If everybody has that information, then everybody can do the same technical analysis. So there's no use in trying to attend additional abnormal returns. You can still get returns, just not abnormal. However, if this was the case, people that had financial statements and estimations of future activity in the company would have an advantage over the people here. So what they're saying is that anybody that has more information than the rest, those people could take advantage of abnormal returns. But as long as everybody has the same information, then nobody will have an advantage. Here is pretty much reiterating what I said. However, the extra thing is that we have analyzed and studied the market through empirical research, and we have evidence that indicates that we are not in a strong form of efficiency. What does that mean? That there's information that some people have and others do not. Some people have private information. That's why you hear about insider trading and stuff like that. Semi-strong. This is what our research suggests we're in. And just like I said, is there implies that fundamental analysis do not lead to abnormal returns, meaning everybody has that information to do fundamental analysis. And the empirical research suggests that this is where we are, that when you look at the returns that can be attained by doing fundamental analysis, then yeah, most of that information is public, and the bulk of the public is able to take action on that. But there's still a piece that is not explained by this. And that's what we say, that there's some information out there that is not available to the public. Weak form efficiency, prices reflect all past. This is the technical analysis side, only past information. Empirical evidence indicates that markets are generally weak form efficient. On average, we are semi-strong. The reason this comes up mainly is because there's a lot of trading activity. And a lot of trading activity is done through technical analysis, especially in this day and age with a lot of technology involved, where they can do things really fast with information as it changes on the market. Now, so what this means is that here, for those people that practice that, they can get proper level of returns. But if you look at long term, typically the ones that apply fundamental analysis, because the information is available, they tend to perform better on the long run. And all it is because they're using more information than what these people are using. The more information you have, the better you can do. Warren Buffett will be an example of somebody that in the long term has outperformed a lot of people because the fundamental analysis is applied. So common misconceptions, I have touched on some of these, but let's go over them. The efficient market hypothesis does not mean that you cannot make money. Yes, you can make money. But what it means is, on average, you will earn a return appropriate for the risk undertaking. On some situations, you might make a little more, but in other situations, you can do a little less. And on an average, you're just going to be getting the risk, the return that you should be getting for the risk you took. There's no bias in prices that can be exploited to earn excess returns. Now, in reality, from time to time, there is some mispricing out there. People catch it, and they could get a few dollars out of it, but it corrects itself really fast. Market efficiency will not protect you from wrong choices if you do not diversify. You still do not want to put all your eggs in one basket. These things they're talking about on average means that you have a variety of investments going on at the same time. If you do one at a time, chances are you will end up losing more than what you make. And this is why they say this. If you do not diversify, this market efficiency is not going to save you. That's it for today's video.